So, imagine this for a second. You have a company,
Okay.
and they just miss their earnings estimates by like a staggering 116%.
Ouch. Yeah, that is not great.
Right. Not great at all. I mean, they are bleeding cash, operating with deeply negative margins, and sitting on, wait for it, nearly $700 million in debt.
Wow. That is a hefty, hefty debt load.
It really is. So by all, conventional fundamental logic, the stock should just be in free fall.
You'd think so. Absolutely.
But instead, over a recent 5-day stretch, it actually rallied, like up 5%.
Which just goes against everything you learn in Finance 101.
Exactly. And top analysts are setting these price targets that are way above its current trading price of around $15.10. So today, we are doing a deep dive into energy fuels. And our mission here is to unpack this massive disconnect.
Yeah, it's a really fascinating situation happening right now in mid-August of 2026.
It is, because they're trying to pivot from being just a traditional uranium miner into this massive domestic rare earth empire.
It is the ultimate test case of what happens when a company's terrible balance sheet basically collides head-on with a national security imperative.
Right.
Because if you just look at the raw financial performance, I mean, it screams distress. But then you look at their strategic acquisitions and the Wall Street price targets, and it screams, monopoly in the making.
I look at this whole thing, and to me, it's like watching someone build this massive, state-of-the-art spaceship.
Okay, I like that analogy.
But while they're building it, the rocket fuel is just visibly leaking out the bottom of the ship.
Right.
It's like, how long can you fly on pure potential? Or, here's another way to look at it. It's like building a custom billion-dollar toll bridge across a huge river.
Yeah, and while you're pouring the concrete, you're just hemorrhaging cash, taking out high-interest loans, and fending off bankruptcy.
Exactly. The financial snapshot is atrocious. But if they actually finish the bridge, they own the only route across the river. And they get to charge whatever they want, forever.
Which is a huge upside.
Huge. But the question for us and for you listening is whether they can actually finish that bridge before the money completely runs out.
That is the million-dollar question, or I guess in this case, the $700 million question.
Right. So we are going to look impartially at both the upside of the strategic moat and the very real downside risks of their execution timeline.
Let's do it.
Let's start with the financial reality check. The concrete being poured, break down the damage from the recent Q2 2026 earnings for me, because it was bad.
Oh, the damage is profound. I mean, the street projected energy fuels would bring in around $31.8 million in revenue for the quarter.
Okay.
They missed that by a mile. They came in at just $25.1 million.
Wow. That is a huge miss on the top line.
It is, but the earnings per share is where the floor really falls out. Estimates modeled a loss of 6 cents per share.
Which is already a loss.
Right, already losing money. But the actual reported loss was 13 cents per share.
Good.
Yeah. Missing your target by over 116% usually triggers an immediate, massive institutional sell-off. And if we zoom out to the first half of 2026, we're looking at a net loss of over $44 million.
So that net margin over the trailing 12 months, I saw it sitting at negative 77.3%.
What's right?
So just so we're clear, that means for every dollar they bring in, they are essentially spending almost another 80 cents just to keep the lights on and build out this infrastructure.
Exactly. You're losing 80 cents on every dollar of revenue.
How deep is the hole they are digging here, like from a liquidity standpoint?
Deep enough that liquidity is becoming a really serious concern.
Yeah.
If you look at their free cash flow proxy for the full year of 2025, it was a negative $108.7 million.
So they're burning over $100 million a year.
Yeah. And now factor in their current balance sheet. As of late June 2026, they only have about $58 million in cash and cash equivalents.
Wait, $58 million in cash, but they burned $108 million last year.
Exactly. And you stack that $58 million against a long-term debt burden of over $677 million.
That is insane.
You have a company burning cash rapidly, carrying massive leverage, and missing its top and bottom line targets.
If a friend pitched you a business with those metrics, you would laugh them out of the room.
Oh, I would run the other way.
I mean, their price-to-sales ratio is hovering around 34. A mature mining company usually trades at a tiny fraction of that, like maybe a 2 or a 3.
Right, 34 that's tech startup territory.
Exactly. Wall Street is pricing a company that literally pulls dirt out of the ground as if it were some high-growth Silicon Valley software startup.
It's wild.
And yet, following this disastrous Q2 report, the stock barely blinked. It dipped maybe 1% in after-hours trading and then actually caught a bid. It closed recently at $15.10.
It's actually trading above its 20-day and 50-day moving averages right now.
Right. So short-term bullish momentum, why? Why is Wall Street giving them a free pass on all these fundamental red flags?
Well, because the market is a forward-looking pricing engine. Right now, investors are entirely captivated by the structural transformation underway. They aren't buying the Q2 earnings miss.
What are they buying then?
They are buying the 2030 geopolitical landscape.
Okay, I get the concept of pricing in the future, but a pass this wide implies the macro environment is doing a lot of the heavy lifting here.
It absolutely is doing heavy
Because
lifting.
the entire uranium sector just saw a 15% rally, so they're definitely catching a macro tailwind, right?
Yeah.
Even with other uranium stocks struggling operationally, the whole sector is pushing upward.
Yeah, the broader sentiment around nuclear energy is undoubtedly providing a rising tide that lifts all boats. I mean, we are seeing major tech companies pivot to nuclear to power their massive AI data centers.
Oh, totally.
And the global push for carbon-free baseload energy is stronger than ever. So, Energy Fuels is still a uranium producer.
Right, they maintain guidance to pull, what, 2 to 2.5 million pounds of uranium out of the ground in 2026?
Exactly. So that foundational business provides some buoyancy. But, and this is crucial, sector momentum alone does not explain why top analysts from BMO Capital, B. Riley, and Roth Capital are slapping outperform and buy ratings on this stock.
Yeah, with price targets ranging from $16 all the way to $25.
Right. A $25 target on a stock trading at $15 implies an enormous upside.
So if they are priced like a tech monopoly, what exactly is the technology? Let's transition from the fundamentals to the narrative, this whole mine-to-magnet mode.
This is the billion-dollar toll bridge you mentioned earlier.
Right.
Energy Fuels is attempting one of the most audacious pivots we've ever seen in the commodity space.
Yeah.
They aren't content just mining uranium anymore.
So what are they doing?
They're aggressively building a fully integrated domestic supply chain for rare earth elements. Specifically, they're expanding their White Mesa mill down in Utah to produce heavy rare earth oxides like terbium and dysprosium.
Okay, we hear the term rare earths thrown around a lot, especially in tech and defense circles.
Yeah.
But break down the mechanism here for us. Why is a uranium miner suddenly pivoting into terbium and dysprosium?
Well,
And why does the market care so much about these two specific elements?
so terbium and dysprosium are basically the critical ingredients required to create permanent magnets that can withstand extreme high temperatures.
Okay.
You literally cannot build an electric vehicle motor, a modern wind turbine, or an advanced defense system like an F-35 fighter jet without them.
Wow, so they are non-negotiable for modern tech.
Completely non-negotiable. The problem is the refining and processing of these elements is almost entirely monopolized by China right now.
Right, I heard about this.
Yeah. For decades, the West has been content to just mine the raw ore and ship it overseas for processing because refining rare earths is notoriously difficult and, frankly, it's environmentally toxic.
Which brings us back to the White Mesa mill, because I was digging into the mechanics of this, and the process of refining rare earths actually generates radioactive waste, right? Specifically thorium and uranium.
Exactly. And in the United States, getting a new regulatory license to handle and store radioactive waste takes decades.
Decades and probably billions of dollars in lobbying and environmental studies.
Easily. But Energy Fuels already has the White Mesa mill. It is already an operational, fully licensed uranium processing facility.
Oh, I see.
Yeah, that is the massive regulatory loophole that changes everything.
Yeah.
They do not have to spend 20 years fighting environmental impact studies to get a license to process radioactive rare earth byproducts.
Because they are already licensed for it.
Precisely. They possess the only facility in North America currently capable of doing this at scale. That is the moat.
Wow, okay, that makes sense. Wall Street looks at that reality and realizes that Energy Fuels could become the sole domestic provider of separated heavy rare earth oxides.
Right. It's a structural monopoly waiting to happen.
Okay, so they have the raw materials and they have the regulatory permit to process the toxic byproducts. That gets you the separated oxide.
Right.
But an oxide is basically just a highly refined powder, right? It isn't a magnet. You can't just stick a bag of powder into an F-35 engine.
No, you definitely cannot.
So how do they plan to execute the rest of this mine-to-magnet transition? Because the outline for their corporate strategy points to two major acquisitions pending that seem central to completing this pipeline.
They're literally buying the missing links of the supply chain.
Okay, tell me about those.
So first you have the ASM acquisition, which is expected to close any day now in late August 2026.
Right.
And then there's the VAC acquisition, slated for early 2027.
And what do these two companies actually do?
ASM brings the specialized metallization technology required to turn that refined oxide powder into an actual metal alloy.
Got it. Powder to metal.
Exactly. And then VAC brings the highly specialized manufacturing capabilities to take that metal alloy and forge it into the finished permanent magnet.
So they are literally assembling the pipeline piece by piece. Mine the ore, refine it at White Mesa, turn it into metal with ASM, and forge the magnet with VAC.
Yes, and if they pull this off, they completely bypass China.
Which is huge.
It's massive.
Yeah.
And that is why analysts are willing to overlook a non-existent price-to-earnings ratio. Securing a domestic rare earth supply chain is no longer just an economic goal for the United States. It's an urgent national security imperative.
Right. The Department of Defense and major Western automakers are desperate for a supply chain that isn't vulnerable to geopolitical tariffs or export bans.
Exactly.
It's basically the ultimate build it and the government will throw money at you strategy.
That's a great way to put it.
But, okay, we have to pivot back to the reality of their balance sheet. Because the ambition is monumental, the regulatory moat is very real, but as we established, the bank account only has $58 million in it.
Yeah, that is the rub.
How do you buy two specialized manufacturing companies, retrofit a massive uranium mill, and fund a supply chain empire when your operating cash flow is deep in the red?
You rely on outside capital. The entire thesis of Energy Fuels right now rests on securing massive financial lifelines. The company points to a potential $725 million in U.S. government funding from the Office of Clean Energy Demonstrations.
Okay, so that's government money.
Yeah, and they also reference a $250 million credit facility from Goldman Sachs.
I mean, $1 billion in capital sounds fantastic, but conditional is the operative word in those filings.
Oh, absolutely.
These funds are described as conditional and unconfirmed. They do not have this cash in hand.
No, they don't.
If you are a shareholder, relying on unconfirmed government grants to keep the lights on and service a $677 million debt load is terrifying. What happens if this money doesn't clear?
Well, if the conditions aren't met, or honestly, if the bureaucratic wheels just turn too slowly, the structural premium that's currently propping up the stock price vanishes.
It disappears.
It does. The market is giving them a valuation based on a completed pipeline. If they default on their debt because the government funding is delayed, or if Goldman Sachs pulls the term sheet, the narrative collapses.
And the stock price will rapidly reflect their present-day fundamentals.
Exactly. Which, as we discussed, are grim.
Let's play devil's advocate here. Even if the government money does come through, and government grants often come with intense oversight, margin caps, and sluggish disbursement schedules, the commercial revenue from these rare earth operations is completely unproven.
Right.
They are selling a vision of future cash flow, but nobody actually knows what the margins on that cash flow will look like once the pipeline is operational.
That is the execution tightrope. The structural moat is theoretical until it is proven by commercial-scale revenue generation.
Right.
They have to integrate ASM, they have to integrate VAC, and they have to optimize the White Mesa mill to process these new materials, all without disrupting their core uranium production.
And any friction in that integration process burns more cash.
Exactly. Cash they don't really have to spare.
And what if the ASM acquisition itself hits a snag? Because it's supposed to close any day now, in late August.
The market would react aggressively. Institutional investors have priced in the successful completion of the metallization step.
So if ASM falls through?
Energy Fuels is stuck with refined oxides and no internal way to turn them into the metals required for the magnet.
Oh, man.
They would have to go out and find a new partner or attempt to build the metallization technology from scratch.
Which would add, what, years?
Years.
Yeah.
And hundreds of millions of dollars to the timeline.
Let's talk about the technical setup of the stock, because I think it reflects this exact tension between the visionary buyers and the skeptical sellers.
Definitely.
We mentioned the short-term moving averages earlier, but the relative strength index, the RSI, is sitting above 73 right now.
Yeah.
That shows buyers are piling in incredibly fast right now, completely ignoring the poor earnings.
It indicates a massive surge of short-term conviction, which is largely driven by the uranium macro environment and the anticipation of this ASM closing.
But if we pull the lens back, the long-term trend line is still trapped roughly 46% below its 52-week high of $27.90. The stock has lost over a third of its value in the past 6 months alone, and it is still trading well below its 200-day moving average, which sits up around $17.56. So the market might be buying the dip, but it hasn't actually reversed the larger downtrend.
The 200-day moving average is, the ultimate lie detector in technical analysis.
I love that phrase.
It's true. It separates short-term hype from long-term institutional accumulation. Until the stock can decisively break and hold above that $17.56 level, the market is basically telling us that it is cautiously observing the pipeline construction, but it is not yet fully convinced the bridge will be completed.
It is a high-stakes race between their cash burn rate and their execution timeline. Can they finalize the acquisitions, secure the government cash, and get the White Mesa Mill producing commercial heavy rare earth oxides before the bank accounts run dry?
That tension is exactly what makes Energy Fuels one of the most compelling case studies in the market right now. You have an incredible, forward-looking strategic vision clashing violently with a severely stressed balance sheet.
So, synthesizing this for you, the listener, the core takeaway from this deep dive is that Energy Fuels represents a massive geopolitical bet disguised as a mining stock.
Well said.
It is an unprofitable company, heavily weighed down by debt, yet it is uniquely positioned to exploit a critical national security vulnerability with its regulatory licenses and targeted acquisitions.
It perfectly illustrates how the market will completely ignore traditional fundamental analysis if the underlying narrative is powerful enough.
Right.
The market isn't blind to the debt or the cash burn.
Right.
It is simply calculating that the U.S. government and the defense sector literally cannot afford to let this domestic supply chain fail.
But relying on too important to fail is a very dangerous game for retail investors.
Oh, absolutely.
So what are the immediate turning points you need to watch for over the next 6 to 12 months if you are tracking this thesis? First and foremost is the closing of that ASM acquisition here in late August.
Yep. If that goes through, it dramatically de-risks the middle of their supply chain.
Second is the confirmation of the $725 million in government funding. Does the money actually hit the bank account, and what are the attached covenants?
That's huge.
And third, they cannot take their eye off the ball with their core business. They need to hit that uranium production target of 2 to 2.5 million pounds for 2026.
Because they are using their traditional uranium mining to provide base liquidity while they build the rare earth pipeline. If uranium production slips, their cash burn accelerates.
Exactly. And on the technical side, watch that $17.56 level. If the stock tests that 200-day moving average and gets violently rejected, we will likely see a resumption of the long-term slide.
But if it breaks through on high volume, it signals that large institutions are finally buying into the completed narrative.
It requires extreme vigilance. You cannot just park your money in a stock with negative 77% margins and forget about it.
No, definitely not.
Every single link in this new supply chain has to be forged flawlessly, which leaves us with a final overarching question for you to mull over. In a global economy where supply chain independence is increasingly viewed not just as a competitive advantage, but as a matter of raw national survival, how much of a premium is the market ultimately willing to pay for a company trying to build a domestic rare earth pipeline from scratch? Does geopolitical necessity eventually overrule financial reality?
The outcome here will provide the answer, and it will likely set the valuation precedent for the entire critical materials sector for the next decade.
It's going to be wild to watch. Thank you for joining us on this deep dive. Keep your eyes on those catalysts, watch those execution timelines, and we will catch you next time as we unpack the market's most fascinating stories.